Knowing when to refinance can be complicated, but I'm going to share some basics so you'll know if it makes sense for you to refinance your mortgage. I'm going to give you a checklist and some things to think about before you refinance. We'll also discuss a streamlined refinance available to many government loans like FHA, VA, and USDA. And then lastly, some frequently asked questions about refinancing. Let's go with the checklist. Here's my checklist. You should probably refinance if 1. You're saving at least 1%. You're saving money in your interest over the life of the loan. You rarely want to refinance if your interest rate is going up. The second item on the checklist, can you break even on the refinance within 3 years? Refinances are not free. So if you refinance your loan, it's going to come with closing costs because they're taking your loan, they're paying it off, and they're starting an entire new loan for you. So you would save money on the loan, but initially it's going to cost you money. So you want to make sure that you're going to break even within 3 years of paying that loan back. And I'll give you an example later in this video. Number 3, you need to remove somebody from the mortgage. Often this happens in divorces where you purchase a home with your spouse, or maybe you purchase it with another family member and they want to be removed from the mortgage. Maybe they don't need that on their debt to income ratio because they're trying to buy a new home. So sometimes you need to refinance in order to remove somebody from the mortgage. Now, if it's court ordered where they're making you refinance the loan, then you may be refinancing at a higher interest rate. This is not ideal, but it's something that you may have to do. Number 4 on the checklist is you need a fixed rate. Maybe you had an adjustable rate mortgage and you want to get a fixed rate mortgage. And this should be hopefully that you're coming down on your payments to a fixed rate, or maybe you're coming close to the same amount, but you're able to stabilize that payment over the long term. 5 on our checklist is getting rid of PMI. So a lot of times when you put less than 20% down, or if you have an FHA loan, a USDA loan, you likely have some kind of mortgage insurance. So a refinance would allow you to get out of that mortgage insurance, but that shouldn't be your only reason. You want to make sure that you're still saving money when you go ahead, or saving money with either getting rid of your mortgage insurance and saving money on the interest rate. Typically, if you're going to save on getting rid of the mortgage insurance, but your interest rate may increase, then that probably doesn't make sense. And then lastly on our checklist is getting cash out. You may refinance your mortgage in order to cash out on some of your equity. We're not going to go deep on cash out refinances, but that might be one option as to why you may want to refinance your mortgage. Many times when you're refinancing your mortgage, you're changing your type of loan, or you may be changing your terms of your loan. For example, you may have an FHA loan and you are refinancing to a conventional loan, usually to get rid of PMI. And you already have maybe 20% equity in your home, so you refinance from FHA to conventional. Or you may go from 30 years to 15 years, or 30 years to 20 years. So you can do all of that within a refinance. You could change your loan type and you could change your loan term as well. Now, here's my example on the break-even point. You want to make sure that you're saving on your interest rate. For example, if you have a $300,000 house and you're going from 6% to 5%, and let's say you're saving $188 a month in interest, but the closing costs on the refinance are around $6,000. So in order for you to make that $6,000 back, it would take you about 31.9 months. Okay, so that's less than 3 years, so that would make sense for you. But be mindful of a couple of things. if you're toward the end of your mortgage term, you don't want, say you have, 8 years left on paying off your mortgage, you don't want to go back to a 30-year mortgage. So, and oftentimes you are going back to the 30-year mortgage unless you're going down to like a 30-year to a 15-year mortgage. Let me tell you an example. My mortgage rate is a 3.25%. And during the pandemic, it did make sense for me to refinance, or my husband and I to refinance to a 15-year mortgage where we can get a low 2% rate. The rates were changing a lot, but at one point we could have gotten a lower, much lower 2% rate, like 2% or 2.25%, something along those lines. But in going from a 30-year mortgage to a 15-year mortgage, although we were saving a lot in interest, our monthly payment would have gone up, not gone down. So this was an example where we actually didn't refinance because I had just quit my teaching job. I was getting started on YouTube, and my husband knew if that didn't work out, he was going to have to take over all of the monthly payments on his own. So he was more comfortable with keeping our mortgage as is. And if we wanted to make extra principal payments to get, to save on interest, he rather had done it that way than to refinance our mortgage from a 30-year to a 15-year mortgage. So that's just an example of, even though we would have saved on interest, he wasn't comfortable with our payment going up. So think about that when you're going from a 30-year mortgage to a 15-year mortgage. Your monthly payment is likely to go up, even though over the long term you are saving on interest. You may want to instead make extra principal payments to pay that mortgage down quicker, faster, and you will also still save on interest doing it that way. But if you can do both, save on your interest rate and save, go from a 30-year to 15-year, that is great as well. Now let's talk about streamline refinances, and then I'll answer some of the frequently asked questions about refinances. So a streamline refinance is available with FHA loans, VA loans, and USDA loans. This makes the refinance process faster and much easier than it typically is. There's no income verification, no credit checks, and no appraisal. When you're doing a typical refinance, they're going to ask you for your income to make sure you're still working, that you could pay the new loan. They will run your credit, and they'll generally do an appraisal on the house. The streamline refinance makes it much easier, especially if you're going to be saving money. So if you're going to be reducing your interest rate, it's very easy if you have a VA loan, FHA loan, or a USDA loan to do one of their streamlined refinances. It still does have closing costs, so you still want that break-even point, but it's much easier to refinance your loan. But let me say this with a streamlined refinance, because we're in a time period when I'm filming this video that mortgage rates are much higher than they were during the pandemic. And so a lot of lenders are saying, oh, you can just do a streamlined refinance, especially on an FHA loan, and you'll be able to refinance your mortgage. And I was thinking, well, if this was so easy, this streamlined refinance, why didn't most people do this during the Great Recession that had, adjustable rate mortgages and all of, or they wanted a lower mortgage rate to make their home more affordable? And one of the things that a lot of these FHA and VA and USDA loans did, they changed the rules on the streamlined refinance during the Great Recession, and they made people submit their employment status and their income, and if they were unemployed, they couldn't do the streamlined refinance. And if they weren't employed, but they were underwater on their mortgage, they made some borrowers pay a lot of upfront refinance fees. So that's why there were still a lot of foreclosures during the Great Recession, because even though they say you don't need income verification, no credit checks, and no appraisal, because they were afraid so many people were going to default on their mortgages at the same time, they weren't willing to do these streamlined refinances without people being employed. So just be mindful if we get into a situation where there are a lot of people trying to do a streamlined refinance, and the government knows that a lot of them don't have equity in their home, they may adjust the streamlined refinance and ask for some of the things they don't typically ask for during the streamlined refinance process. And I'll have a link to an article below that tells you like how this happened during the Great Recession. Now let me answer some frequently asked questions about refinances. One question that I'm asked often is, how often can you refinance? Really, as many times as you want, but it really typically doesn't make sense for you to refinance a lot. How soon can you refinance? Most of the time it's as soon as your deed is recorded. However, your lender may tell you you have to wait for 6 months. 6 months is typically because the lender, if you don't hold on to their loan for at least 6 months, they may not make money on your loan. But if you go out to an outside lender, somebody that's not the lender that you use to purchase the home, then they wouldn't have that 6 month wait period. So just be mindful of that. As long as your loan doesn't have any type of prepayment penalty, you should be able to do a refinance as soon as your deed is recorded and that home is listed as your property. Okay. Another question is asked, closing costs, do you have to pay those up front? Most of the time, your closing costs can be rolled into the loan. So that is a refinance, and I hope this made it a little bit clearer for you about how a refinance works and when you should be able to take advantage of a refinance. Please watch my video about buyer beware for other things that lenders are doing to help you save on your interest rate and make properties more affordable. And this video as well, it talks about when to lock your rate if you are in the market for a home. Thank you for watching. Please like and subscribe to my channel for new videos every week.